Okay. So we were discussing about the Potter's five forces and how this Potter's five forces, okay, can affect the prices and costs in a competitive market where a company is placed. Fine. So companies have more pricing power when the intensity of the rivalry is low. Yes. See, we know in a perfect competition there are large number of firms, okay, which are operating and selling similar kind of products, and there are large number of buyers. The firm doesn't have the, you know, pricing power. That means they are the price takers but not makers. But in opposite to that, we know the condition of a monopolist firm. They are price makers and the customers are the price takers. So when I speak about monopoly or oligopoly, the intensity of the rivalry is less. Okay. Less firms in the sense more pricing power, more firms less pricing power. Okay. Because new firms which are entering can, you know, kind of like reduce the prices and try to sell despite of their volume would be high, but they will be earning less profits, but they don't mind doing that. Okay. Because they want market penetration. Okay. So companies have more pricing power when intensity of industry rivalry is low and less pricing power when the competitive intensity is high. That means more number of firms, okay, less pricing power, less number of firms, more pricing power. Okay. Industry rivalry tends to be more intense when an industry has more competitors, is less concentrated. That means the concentration of the market. That means a firm is not able to, you know, have a bigger chunk of the market because many competitors are there. Many competitors are, you know, coming in and they are making the competition more intense. So the pricing power is lost. Okay. And what happens when fixed costs and exit barriers are high? That is also a big problem. First of all, more entrants, bigger rivalry of the firms, more intense competition, but the fixed cost would be high and the exit to barriers are high. What is exit to barriers? Exit barriers. Exit barriers in the sense, see, barriers to entry is different and exit barriers is different. Okay. That means they cannot easily move out. They cannot easily move out. Barriers to entry is they cannot easily enter. Okay. So when exit barriers are high, more firms are there in the market, fixed costs are high. So when an industry growth is slow or negative and when products are not differentiated significantly, that means industry is not moving that great. Okay. Its growth is negative and product differentiation is less. Okay. So that is the time whereby the pricing power of the companies would be less. Now, next one. So that has an impact on the price and the cost. Pressure on companies' cost may be higher when there is a bargaining power of suppliers. That means suppliers want to sell the raw material to you or to the firm or the company, okay, at a higher price. So when they quote higher prices, what happens? You get the material at higher cost. When you get the metal at higher cost, you have to sell at the higher prices. Okay. So, and also if there are very few suppliers, then the pricing power is with the suppliers only. Okay. So they may be able to extract a larger portion of any value added. That means they will be, you know, kind of very few suppliers are there. They kind of have monopoly. So they'll be charging more to you. The cost will be higher to you. That is not something which you will be liking. Okay. And if you want to create any value to your product and sell and get more prices, that is going to get reduced because suppliers are going to charge you more for the material what they are selling to you. Companies may have less pricing power. Okay, when bargaining power of customers is higher, that means it's a buyer's market whereby you have to listen to them. You have no other alternative. Customers are pressing you. So then what happens? Your pricing power will be less. You have to sell at lower prices. Okay. Especially if a small number of customers, that means, you have some very big customers. Okay. You may be having handful of customers, but they are, dominating customers, or they purchase in bulk from you. So that point of time, you have lesser pricing power, and they have a greater bargaining power. Okay. So especially if a small number of customers are responsible for a large proportion of firm sales, or if switching costs are low, that means they don't want to, or they don't want to take from you, because they always tell you or challenge you that others are giving to us the raw material at the lower prices, so they can switch immediately from you. So what is the remedy you have? You have to sell at lower prices. You have no other option. Then companies have more pricing power and better prospects for earnings growth when the threat of new entrants is low. Yes, when less firms entering into the market and less intense competition, you have, a better pricing power. You can charge more to the customers because you are dominating. And significant barriers to entry into an industry make it possible for existing companies to sustain economic profits over time. Now, explain how to forecast industry and company sales and costs when they are subject to price inflation or deflation. First of all, inflation is nothing but the condition where the prices of the goods are high, and deflation is the condition when the prices of the goods are going very low. China is facing deflation right now. India is facing inflation. Deflation is even more dangerous than inflation. Why? See, what has China done? If you see China, they have built some cities, okay, which are called ghost cities. Ghost cities doesn't mean that ghosts are there in those cities, fine. So don't take it in that way. Ghost cities are, or ghost towns are those whereby the towns are already built, but the people, okay, but the people who have to, start, living there, okay, or the dwellers, how, or I say that the people who want to, start their life in that city, etc., have not yet come. That means Hyderabad, if I take Hyderabad as a city, Hyderabad as a city is growing, in 360 degrees. Every area you see, there is a constant growth. 10 years back, when you see some area like Kukatpalli or something, or High Tech City or Madhapur, it was nothing. Now what has happened? That area has already developed. Now it is going to Sangareddy. Now all the areas, every area you see is like going 10, 20, 30 kilometers, beyond. And what is happening? Hyderabad is having a proper growth. Why? Because as the city is growing, people are, buying properties, and people are starting residing. Imagine when I build an entire Hyderabad city and ask people to come and reside in Hyderabad. It's not possible, because this city has not is not built overnight, right? This city has a history of 200 or 300 years. So since that time, it's growing slowly and steadily, and people find prospects. They see history, they see culture, they see legacy, etc. You ask, when you build some apartments, you make some big cities and ask people to come and reside, it's not going to happen like that, because people find it difficult, because there's nothing right now. Okay. So what has happened is they made like that, and the property prices have, and they are trying to sell those properties. People are not ready to buy. What China has offered is, you take the properties for free, no problem, okay, and reside here for some X number of years. After that, you start paying. That is not working out. What China can do right now? So that is that condition whereby the prices are not at all going up, but the prices are going very down because of no demand, and still no one is ready to buy, no prospects. That is called deflation. It's very dangerous. And many real estate firms in China have collapsed, has created ripples in Chinese market.
So, sir, deflation restricts development.
Yes, deflation is not good. It's like, constantly going on reducing the prices. So when the prices are getting reduced, okay, that means there is oversupply, or there's no demand. When there's no demand, how the market will, expand, or how the market will move on? It will not move on. Fine. Next. So we will see something right now. Explain how to forecast. See, we can forecast the company's future sales, right? And also the cost, which is which we are going to incur. Now, a very good forecast of the CFA program, you can see. I've been seeing the trend of the fee structure of the CFA Institute, what they are charging. And I am seeing that every year there is a increase in the CFA program fee structure. Okay. And students or many folks, they meet me and they complain about it, that the prices are constantly increasing. Yeah, see, the certification is a meritorious one. It's a gold standard, gold rated certification, and a unique one. It's one of its kind. Okay, you don't have any other certification as such in the world, and they are not doing it purposefully. They say that there is a inflation and education inflation. Because of that, things are costing them a lot every year. It's like not easy for them to maintain themselves, being a non-profit organization as well. It's like very tough for them to maintain everything like that. They have a lot of expenses, and it's constantly increasing. So they are increasing the prices, and that's what is their explanation for the for the rise in the prices. So in the same way, we can now even forecast the future fee structure. Okay, everything you can forecast. You can forecast, like you've been eating McDonald's burgers, and the burgers prices have gone up. I have eaten a McDonald's burger for 35 rupees. Now I'm paying 90 rupees. So things are becoming costlier more and more, and the cost everywhere, there's a chain. If the fuel prices increase, the cost of the raw materials of everything would increase. And when when the basic needs, what on which we rely, those needs are costly, of course that's going to have an impact on us, okay, on our savings. And then the wants also become distant dream for us, because when we save less, we cannot buy much of the comfort giving products or luxury products. So now in this context, let's discuss what the textbook has to say. Input cost can be significant in many industries. Yes, it matters. The cost of jet fuel in the airline industry, the cost of grains to cereal and banking companies, the cost of grains. See, this grain, if you take rice and wheat and all, it becomes costly, it becomes tough for us. Banking companies, they raise interests. Cost of coffee beans to coffee shops and all are variable. Okay, they are not fixed, they change in these costs can significantly affect your earnings. Of course, even the prices of the raw metal increase, you have to add that extra cost and you have to pass on to the customers. You can't do anything. Now, companies with commodity type inputs. So if there are some companies like FMCG products, some companies deal with food grains. Okay, like bakeries, they depend upon wheat, flour, etc. They can hedge this increasing prices of the food grains or commodities. Commodity can be anything, boss. It can be metal. Steel company wants iron ore. Petroleum companies want crude oil. Okay, so all these are commodities. There are commodities which are consumable commodities, which are not inconsumable commodities. Inconsumable commodities can be metals and all. Consumable can be food grains. So you can use derivatives. Okay, you can fix the prices today. Okay, for those products which you want to buy in the future, and in the future you will buy at the price which you fixed today, or made a contract with the seller of that particular commodity. Okay, with this, what happened with this price fixing agreements in future, even though the prices are high or low, it doesn't matter. You will buy the commodity at the price you fixed today itself. Fine, that reduces your risk of increase in the prices or price fluctuations. So I'll mention some derivatives. However, we are going to discuss derivatives in details in the coming sessions. Derivative, I'll just give some data here or some information. Forward contracts, futures, options, swaps. These are the 4 derivatives. So these are the ones which can help a particular person to protect them from any kind of increase in the prices of certain commodities with which they deal, or they want to buy in the future, and they are kind of having a fear that the prices of those commodities are going to be very high. Okay, so for a company that neither hedges, so this particular activity or act of saving ourselves from the increase in price or price or price risk. Okay, higher price risk. So if we want to save ourselves or protect ourselves from these kind of risk, then we will use all this, and this act is called as hedging. With hedging, we try to minimize our risk. See, one small example can be, see, everyone in the world is not safe always, right? When we travel, when we walk on the streets, we cannot deny the fact that we can like anyone can meet with an accident, right? So there can be a very big loss to our to any part of the body. Like we can encounter a fracture or something, and then people have to get admitted to a hospital, and the bills for the hospital, the medical expenses are very high. So how come a person can minimize that kind of risk of paying a very high bill immediately, when he would not be in that condition to pay? He would take insurance policy for that, right? So he will get himself insured, so that insurance acts like a like can minimize the losses. Okay, and that kind of activity can be said as hedging. Hedging are medical bills with insurance policy. Okay, so for a company that neither hedges, so there are some companies who do not do this. Input price exposure or the risk of input price increasing, nor is vertically integrated. The issue for an analyst is to determine how rapidly and to what extent an increase in cost can be passed on to customers. See, vertical integration is what? Vertical integration is a company which is dealing with everything right from scratch, from the raw materials to the finished goods. Can I get some example from you for vertical integration? Vertical integration, if you can tell me, if you
Sir,
know.
can you once define vertical again?
See, vertical integration is what? There are two types of integration, okay? Vertical integration is nothing but the company which makes everything from scratch.
Okay, from raw materials.
Yes, yes.
Like
So everything.
cotton,
So if you can give me a small example of vertical integration.
cotton, like
No, vertical integration. See, what we say?
petrol.
See, yeah, a company acquires a business that operates before or after them in supply chain. Example, manufacturing company might acquire a retail company. See, what happens is, I'll give you a small example. Wait, I'll write it down. So vertical integration is nothing but like the major difference between horizontal and vertical integration can be, first you should know what is horizontal integration, okay, or vertical integration. See, it occurs when a company wants to expand itself first, okay, and acquires a company outside of their current position along the supply chain. Okay, so manufacturer may acquire a retail company so that the manufacturer can not only control the process of making the good, but also sell the good as well. Okay. But what about the horizontal integration? Strategy of acquiring other companies that reside along a similar area of the supply chain. Manufacturer may acquire a competing manufacturing firm to better enhance its process, labor force and equipment. That means a manufacturing company going into its own manufacturing company only. See, horizontal integration and vertical integration, you should understand one difference. See, I'll read out the horizontal integration for you. Horizontal integration is the strategy of acquiring other companies that reside along a similar area of supply chain. Let's say you are here and in your area there are 5 companies. Okay, let's say 5 companies, 1, 2, 3, 4, 5. And these you are manufacturing and these are also manufacturing. So you want to acquire one of the manufacturing firms for what purpose?
Scaling.
So that in a better way you can produce more goods. Okay, you can increase the process. That means in both the companies, both the manufacturing firms are manufacturing, right? Labor force will enhance. Okay, and your equipments will also enhance. Correct or wrong?
Yes.
So one manufacturing firm acquiring another manufacturing firm for what reason? For increasing their labor, for increasing the equipment, for increasing the production process, etc. This is horizontal integration. Okay, that means going into the same line of business, not at all trying to change anything. You want to go into the same line of business. Okay. You want to expand, you want to diversify, but in your own area. Are you understanding?
Yes.
Okay. But what about the vertical integration? It's like, a manufacturing company is existing here. That company do not want to buy a manufacturing company, but instead they want to acquire a retail company. For what reason they want to acquire retail company here? Whatever they manufacture, they want this retail company to sell it properly in the market. Okay, so this guy is on. So what is happening? Manufacturing company may acquire retail company so that manufacturer can only control the process of making the good, but they also want to control the selling process of the goods as well. So they want to, they are expanding, but they are into two different processes. Here they are into the same process. That's it. So they want to have the control of manufacturing, and they want to have the control of manufacturing, control of sales. So they are entering into a different kind of area. Okay, what they were into, they are not expanding themselves into that area, but they want to expand themselves into a different area as well. That's what that is vertical integration. So one small example is Tata company. If they want to expand, they are taking Ford Motor Company's factory in India. So both are manufacturing cars, right? They can use this facility to manufacture the cars. Okay. With this, they got more labor force. They got more processes can happen and more machinery they got. Correct. This is horizontal integration. And vertical integration. Same Tata Motors do not want to acquire a manufacturing company, but they want to acquire what? They want to acquire a company which makes accessories for Tata's cars. So what is happening? That is a different process. This is a different process. Okay, understood? This is not the same process what they are looking at. They are looking at different processes. Are you understanding?
Yes.
Okay,
So that
one more. Okay, so Tata has known that there is some dealership selling Tata cars around India. So they have, valued. They offered some value to the dealership that they are going to pay $1 billion for getting the entire market from that dealer. This Tata want to run that dealership as well. So $1 billion paid to ABC a company who are dealers, and then acquire the dealership, and everywhere now Tata is selling the cars with their own management. So they are manufacturing as well as selling. This is vertical integration. So not going into the same line, but going into different line. Next one. Where were we? Yeah. So an analyst should monitor a company's production cost by product category and geographic location with a focus on significant factors that affect input prices. See, there are many things which can have an impact on the input prices, right? So where a company is buying the raw material from, and what kind of geographical location is that, like the raw material what the company is getting, at what price they are getting it. Okay, what are the factors that can increase the prices? There can be any reason, whether, okay, the government regulation, the taxation, the tariffs. Okay, when you buy goods from other countries or import, tariffs are levied, right? And the characteristics of input markets. It may be that a firm can reduce the impact of an increase in an input price by switching to a substitute input. Yes, see, if some input, is kind of, increasing your cost or enhancing your cost, you can switch to other substitute of that, right? If the switching cost is low. For example, rising oil prices. See, if at all there is a company which uses oil as a fuel and rising oil prices is, impacting them, okay, like, impacting their revenue or sales, they can switch to natural gas, which can also be a fuel for them. See, I did the same thing. I had a petrol car previously, and that petrol car was costing me a lot. My monthly fuel bills were very much high. Okay, I was spending 8,000 rupees every month only for my car petrol charges. Now I bought a CNG vehicle, which is costing me only 3,500 for the same number of days which I drive. So I am saving how much? 5,500, right? Sorry, 4,500. So this is what is like, something to which I switched, right? Now, when estimating, but see, for me, it matters, right? The switching cost should also be less. CNG vehicles are not cheaper than petrol, but I considered a lot of things and I took this. When estimating the effects of an increase in input prices, an analyst must make assumptions about company's pricing strategy and the effects of price increases on the unit sales. See, how the companies should price their product is very important point. If the prices are constantly increasing, that can have an impact on the company's number of units what they sell. So when increase in input costs are thought to be temporary, a company may cut other costs like advertising expenses, etc. Many companies do. You see Amul. Did you see any celebrity kind of advertising Amul butter or Amul's products? No. People know Amul is butter and butter is Amul. That's it. We know that from the childhood, right? So when increase in input cost are thought to be a temporary phenomena, that during some it is like temporarily the inputs whatever we are buying the raw material are costly, and after some days or after certain months things will normalize. So company may try to adjust like other areas to reduce their costs. Okay, the increase in the input costs they are trying to compensate, or they are trying to balance with reduction in advertisement expenses. So what is happening, they're trying to balance here. Okay, neutralize the effect. Just a second. Yeah. And so they are trying to, balance this, because, if the input prices are increasing, they cannot for temporary reasons, they cannot suddenly increase their, the price at which they want to sell, because others, they have to watch the other firms, uh, kind of, what we say, other firms reaction to this. Okay, if the other firms are not reacting immediately for the same thing, then the firm, about which we are speaking right now, will also not react immediately. Fine. In oligopoly market, the firms, when there are few firms, they closely watch each other's reaction to, changes in certain input prices, or certain other factors. So they will do temporary arrangements, okay, so that it may not impact their operating margins. And so it is going to, impact their operating margins by what way? See, if they reduce their advertisement expenses, operating margins are going to be, like stabilized one. Why? Input cost increased, okay, and their advertisement expenses also were very high. Now they don't want a very bigger impact on their operating margins. So what they did is they reduced the advertisement prices and they tried to balance it. So this is stable now. So this strategy is, however, not appropriate for long-term increases in input cost. The effects of raising a product's price depend on its elasticity of demand. What is elasticity of demand? The responsiveness of demand to changes in price. How the demand responds with respect to changes in price. If the price increases by 10%, the quantity demanded of the product, okay,
will decrease.
gets reduced or decreased by how much percent? If it is by 70%, it's, very highly elastic. If only 5%, it's lowly elastic. Okay, so for most firms, product demand is relatively elastic. That means with a change in price, the quantity demand changes with lesser percentage. With elastic demand, the percentage reduction in unit sales is greater than the percentage change in price, and a price increase will decrease total sales revenue. So in elasticity of demand, what we say is, whatever the percentage the price is increasing, the number of units what we sell is going to, reduce by a larger percentage. Okay, and price increase will decrease the total sales revenue. That is also happening. So number of units will decrease with increase in price, and also with increase in price, the total sales revenue is going to decrease. So elasticity of demand is most, this is also one of the factors affecting the sales. So elasticity of demand is most affected by availability of substitute products. In a competitive industry, the pricing decisions of other firms in the industry can affect the market shares of its competitors. A company that is first to increase prices in response to increased cost will experience a greater decrease in unit sales. That's what I say. They always closely watch their competitors, what they're doing, and see the reaction. Then a company that increases prices after other firms have already done. So the first mover will suffer first. So a firm may decide to do what? Delay increasing prices to gain market share when other firms increase prices in response to increased cost. So this is what they want to play smart. Okay. So if a company that is first to increase prices, of course, is going to suffer with less units of sales, what they're going to do, or they can expect greater decrease in sales than the company which increases prices after everyone has done. Okay, so a firm may try to delay the increase in prices because they want to gain the market share when other firms have increased their prices. Okay, the price increases because of the increased cost. So firms that are too quick to increase prices will experience declining sales volume, while firms that slow to increase prices will experience declining gross margins. So the firm which very quickly decreases the prices will experience what? Immediate decline in the sales volumes. But the firms which are slow to increase prices, in the beginning they are not increasing the prices, but later on they will increase. If they are selling at lower prices, their margins, the gross margins will decrease, the gross profit will decrease. And if you understood this point, right? Hello.
Yes. Yes.
Yeah. Because if they don't increase the prices and they do it very slowly, their gross profits are going to decrease, right? Because they are selling at lower prices, which is not suitable for that market where the inflation has already come.
So it should
So
not be
if the,
first or last.
sorry,
It should not be first or last to increase price.
yes. So they should very properly and cautiously watch everything in the market and the reactions. So if the money amount of increase in cost per unit is added to product price and unit sales do not decrease. So what they're doing is, if the money amount of increase in the cost per unit, that let's say it costed you $10 and you're adding $2 to it, dollar value. So the money amount of an increase in cost per unit is added to product price and the unit sales do not decrease. The amount of operating profit is unchanged. That means with increase in cost also, if the sales are not decreasing, then your operating profit is not going to get impacted, but gross margins and operating margins and net margins will decrease. Margin is always you are calculating upon sales. That means gross margin is gross profit by sales, operating margin is operating profit by sales, and net margin is net profit by sales. This will decrease. Are you understanding why this will decrease? Because your denominator is going to decrease, correct or wrong?
Yes.
When the price is increasing, the sales will decrease. But what they said, see, if the money amount of increase in cost per unit, let's say if the money amount of increasing, we are increasing the cost, okay, and we are adding the same amount to the product price which we are selling. The increase here is also going to increase the prices, correct or wrong? Let's say the price is 15 rupees dollars, so we are going to add $2 here. So if the money amount of increase in cost per unit is added to product price and unit sales do not decrease, that means number of units what you are selling is not decreasing, the number of units are the same. The amount of see, if the same kind of increase we do here, the operating profit is remaining unchanged. Why it is going to remain unchanged? Because there are some fixed expenses which you are going to see between the gross profit and operating profit, right? Those are not going to change. Whatever your whatever the changes you are going to see is only in the sales volume and sales and COGS, correct or wrong?
Yes.
But operating profit is not going to get impacted because of the fixed cost or fixed expenses between gross profit and operating profit. So don't worry, we are going to see the same thing here with the help of an example. See, effect of price inflation. Let's say the things have increased in this market on gross profits, gross margins, and operating margins. What we discussed right now, the same thing we are going to see like practically. Effect of price inflation. When there is a inflation, the prices are going to increase, and how that is going to impact the gross profit, the margins, which we are seeing here. Profit is a dollar figure, margins are, you divide the gross profit upon sales and see the percentage. Alfredo Inc. sells a specialized network component. Firm's income statement for the past year is follows. Revenues were, they were selling 1,000 units for $100, 1,000 units for $40 is what the cost for them was of selling that. And gross profits, selling, general and administrative expenses, and operating profit. Now what has happened is, in 2002, the input cost will increase by $5 per unit. So we are going to increase this by dollar amount. So 40 plus 5, I'm going to do it. It is going to be 45. Right? Correct?
Yes.
Yeah, the same thing will be reflected in the selling price also. I'm going to increase the selling price also by $5. Correct or wrong?
Yes.
Yeah.
105.
So that's what, if the money amount of the increase in cost per unit is added to product price and unit sales do not decrease. So you are increasing the cost and you are adding to the product price as well. So they are giving you some questions. Calculate the gross margin and operating margin for Alfredo Inc. in this particular year. Yeah, you have to, the changes are happening in which year? 2002. So first we will calculate the gross profit margin. It's going to be 60%. and operating margin is going to be 30%. They have just calculated. Give me a second. And in 2002 we will make the changes. So given an increase in unit price of $5, no change in units sold. Number of units are same, right? So we increase this, we increase this, and we see all the figures. What we are seeing, what was the gross profit? 60. What is the operating profit? 30. Do you see any changes in this?
No.
No. What has happened? The number of units are same. The only thing is $5 increase here and here. And these are always the fixed expenses. Gross profit is the same. Gross margin is this and operating margin is this. What has happened is only what has decreased? The gross margin and
Operating margin.
operating margin. That's what we discussed.
So the gross profit, sorry,
See,
operating profit.
they clearly said operating profit is unchanged, but the margins will decrease. Okay. With increase.
Gross profit will be same.
Sorry.
Sorry. No.
Yeah, gross profit is same, right?
Yeah.
Yeah. The margins will decrease. The margins are decreasing, right? Why the margins are decreasing?
Because the net sales are, there's a change in net sales.
Said that time. I said the margins will decrease. So margins will only decrease if your numerator is less and denominator is more. Yes, your denominator is more. Yes. See, previously, what was your formula which you used? Gross profit by net sales into 100, right? What was the gross profit percentage previous year? Gross profit was this and the sales was this. So the numerator was, this and denominator is this. Now what has happened? The numerator is the same, but the denominator has increased. With increase in denominator, what will happen? The margin will
decrease.
Okay. See, with if I don't know, I have used what terminology that time. If the see, what will impact if the numerator?
You said, the numerator decreases, denominator.
I think I don't know. I said that. Okay, so that was like, I was in some other calculation maybe. So I'm just doing a small correction there. If the numerator increases, the ratio increases. If the numerator decreases, the ratio decreases. If the denominator increases, ratio decreases. If the denominator decreases, ratio increases. Fine, understood?
Yes.
So here what is happening? The denominator, which was 100,000 previously, has become 105,000 in both the cases. And the numerators are the same, constant.
Okay.
So that will definitely decrease the margins. So denominator increases, the ratio decreases. This is proof. Next point. So when increase in the unit price is $5 and the decrease of 50 units sold, that means we are increasing the price and the units are decreasing, constant decrease. We see the margins to be less. So you can see this all combinations. Fine. The denominator has, when number of units you are selling less, you see that gross profit margin, gross profit amount is this, operating profit amount is this, and the sales amount have also what decreased, right?
Yes, everything is reduced.
Yeah. And the decrease in the gross profit and operating
Gross margin is same.
is also seen, and we are not seeing a bigger change. We are seeing that both are decreasing, correct?
Yes.
Yes. Now, if it is a further decrease, then we see there is a further decrease. Finished. But the decrease in the operating margin is more when compared to gross margin. Why? Because gross margin depends upon the variable aspect, but operating when this decreases, operating profit decreases furthermore. Why it is like that? Because we have to bear the brunt of the fixed cost. We are not able to take the advantage of fixed cost when the revenue decreases. Are you understanding?
Yes.
See, when the revenue increases, your fixed costs seem to be like peanuts. But when your revenue is decreasing, your fixed cost seems to be like what? A
Very
burden.
big. Yeah.
Burden, right? So here your revenues have decreased. Okay. So what? But the fixed cost is same. You are not able to take the advantage of your fixed cost of selling general and administrative expenses because the revenue you are selling less units now, you are generating less revenue, so you find it difficult to absorb or adjust this one. But if you earn very high, if the revenues are like 5 lakhs, this becomes it becomes peanuts, like, correct or wrong?
Yes. It is easy to manage.
Yes. So these are the calculations. Now the last question, see, this particular chapter has everything. This is a chapter like, they're covering the accounting part, and they are also covering a lot of economics concepts as well.
And biases.
Yeah. So explain considerations in the choice of an explicit forecast horizon. See, explicit forecast horizon is nothing but taking a long period whereby company has performed very constantly. Okay, constantly it's been performing, and constantly it's doing good, and constantly it's growing. And an analyst choices in developing projections beyond the short-term forecast horizon. So horizon is nothing but time period. Short term is for short span of time, and explicit forecast horizon can only be for a long period of time, because a firm can be stable only in longer periods. So from a buy side analyst, appropriate forecast horizon may simply be expected holding period for a stock. Let's say if you are someone who are suggesting someone to buy some stock or something, the forecast horizon of the time period you take maybe simply be the expected holding period for a stock. That means how much time you're going to hold the stock, like it's going to be for 5 years or 10 years or so. For example, they have given a portfolio with 25% annual turnover has an average holding period for 4 years. So 4 years may be the most appropriate forecast horizon. So they say if you are having a portfolio, okay, of some stocks, okay, with 25% annual turnover, okay, 25% annual turnover is nothing but what?
Sales.
Sales. So
Total.
100% will happen in how many years?
Five, four.
4 years, of course. 25, 25, 25, 25. So you are taking a average holding period of 4 years, correct? That means on an average, if you are selling 25% of the goods, what you make, so 4 years you take for 100% to happen. So we see very highly cyclical companies whereby as it starts from one point and ends at one point. So there's a cycle. Present difficulties when choosing a forecast horizon. The horizon should be long enough, as I said right now, that the effects of current phase of economic cycle are not driving above trend or below trend earning effects. That means if you take a long period, it will be easy for you to study the fluctuations, okay, and properly the fluctuations effects can be also seen. Otherwise, in short term, you may not be able to study that, and you may give a wrong kind of suggestion to the the client to whom you are giving your with whom you are are in consultation, or you're giving your consulting. So the
Outdated.
forecast horizon, yeah, should be long enough to include the middle of the business cycle, so that the analyst forecast includes a mid-cycle level of sales and profits. Normalized earnings, that means the earnings which you can show on a normal distribution with some average earnings and also some fluctuations like standard deviation of the earnings above or below this, are expected mid-cycle earnings, or alternatively expected earnings. Expected earnings are nothing but mean or average earnings when the current effects of events or cyclicality are no longer affecting no longer affecting earnings. Okay. So normalized earnings, which nothing but you can show on a distribution, are expected mid-cycle earnings. Okay, expected means average, or alternatively, you can use this word expected earnings when current effects of events. That means some events which can have an impact on your earnings or cyclicality are no longer affecting earnings. That means there is no impact of any events on your earnings. So this is what is the normalized earnings. You have taken all the factors and you have calculated your average earning. That's what. So by using probabilistic model, that this much you will definitely expect in the future. Events such as any kind of acquisition or merger or restructuring which a company is going to in future plan for, you should consider them as a temporary one, because that will happen for once and then things will move on. The forecast horizon should be long enough that the perceived benefits of such events can be realized, or you will not be able to see the benefits. So all in all, what they are saying is, don't go for short term forecast, go for a long term only. Study the company's cycle. Okay, company's cycle, and take the horizon of some 5 to 10 years to study the company's profile properly. Now that means what will happen is you'll be not missing some data. It may also be the case that forecast horizon is dictated by an analyst's manager. For earnings projections beyond the short term, one method of forecasting future financial results is to assume that the trend growth rate of revenue over the previous cycle will continue. Yes, you are saying that the trend should continue. Analysts can estimate pro forma financial statements. That means estimated financial statements based on the projection of each future period's revenue. We have already seen how to make the pro forma financial statement based upon the revenue, right? The first question. Analysts will typically value a stock using earnings or some measure of cash flow over a forecast period. If they want to value a company stock, they can use the earnings as a metric or cash flow as metric, along with the stock's terminal value. Terminal value is nothing but the value which a stock may have on the last day of that stock you want to hold for. See, stock doesn't have a maturity, first of all, but you have set a horizon, right? You want to hold a stock for some 5 or 10 years. So that on that particular date, till the date you want to hold it, what its value can be, you are forecasting. That's called the terminal value. So an analyst will typically value a stock using earnings. Okay, see, you can how you can value a stock. You have price to earnings ratio, right? Price to earnings ratio is what? Market price of a share by earnings per share. Okay, so this particular P ratio can give you the forecast of company's future, correct or wrong? If I will give you a P ratio of company as 5 and I give you EPS as $10, okay, so can you find out the market price of a share? Please tell me. Yes.
Yes.
That's what. And they can also take the cash flows, future cash flows, and discounted cash flow technique they can utilize for finding out the stock value, present value of future cash flows. That means future the cash flows will be what? Dividends every year. And let's say you want to hold the stock for 5 years. You have done a forecasting of that value. So 5 years dividends, dividend 1, dividend 2, dividend 3, dividend 4, and dividend 5 plus its terminal value, and all this discounted by your expected rate of return will give you stock price. That this terminal value is usually estimated using either a relative valuation approach or a discounted cash flow technique. As I said you right now, you can find out a stock value by using discounted cash flow technique also. How? See, all these things you have not learned, so you may be finding it difficult. Stock price is equal to dividend by cost of equity. This is the formula. So let's say the dividend is $10 and the required rate of return what you have from the stock is 10%. So your stock value will be what? $100. Finished. Don't worry, we will be starting the equity valuation concept as they already have mentioned here. We will be learning about how to value a stock. Okay.
Okay.
So when using a multiples approach, already P ratio I have explained you right now. An analyst must ensure that the multiple used is consistent with the estimate of company's growth rate and required rate of return. Using the average P ratio for a company over last 10 years, for example, presupposes that the growth in earnings and required rate of return of the stock will be on an average the same in the future as it was over the previous 10 years. Of course, if you are taking P ratio and based upon that you want to forecast the company's future, or you want to know something, for example, presupposes that the growth in earnings and the required rate of return of the stock, that means you are saying what will be the growth, okay, in the stock price and the required rate of return of the stock. So if you are taking 10 years time, you'll be taking on an average, correct or wrong? That means we are not speaking about the P ratio for one period. We are speaking about the average P ratio. So 10 years average P ratio can tell you about the average earnings and the average required rate of return, correct or wrong?
Yes.
That's what. Using the DCF technique, you can calculate the stock value. We have already discussed. And last point is, assuming that the growth in future profitability will be the same as average profitability. Let's say the average profitability was 10% and you're expecting that same kind of growth. See, growth in future profitability, growth is different from the average profits, but they are saying what? Let's say the growth in future profitability, you are expecting that the profits in the company in which you are an investor, that company's profit is going to grow by, let's say, 10%. That is what it is, nothing but equivalent to the average profitability growth in the past, okay, and that may not be justified. So assuming that the growth in future profitability will be the same as average profitability growth in the past, it is not justified. Why? The conditions in the past and the conditions in the future are not same. So if you say that in the past 10 years my growth was 10% and the next coming 10 years my growth will be 10%, it's not going to happen. It can be more than 10%, can be less than 10%, right? Or can be equivalent also, equal also. It is a mere coincidence. So a difficult part of an analyst job is recognizing inflection points. What is these inflection points? Those instances, just a second. Those instances when the future will not be like the past. So where you can see the future will not be like the past: changes in economic environment, business cycle stage, government regulations or technology. On basis of all these factors, we cannot say that the future will be the same like the past, right? And that is what you call it as inflection points. You cannot predict the government strategy going to be in the future regulations of the government, how the government is going to be strict or lenient. You don't know about the India's or the country's economic environment, what's going to be. Now you see what kind of things are happening. Everywhere there is war mongering happening, right? A fully blown out war can change the course of everything. So the future prediction we cannot do accurately. Henceforth, we cannot say that in the past what has happened will happen in the future. Fine. So analyst has to be very much concerned about all these factors. With this note, we conclude this chapter. The next topic, what we'll be doing is, I think we can take up the first chapter. If I have a video of this, I'll try to see. If I have, I'll share with you because it's a theory topic only. If not that, we will start something else. Some other topic we'll take up. Okay, some other book. Fine. Sure. Thank you.
Thank you.
Thank you, dear. Thank you.